Hey folks, so we are now about 10 days into a fairly classic bear market rally, at least by historical context. And so I wanted to take a minute to put things into perspective and really, more importantly, warn you not to chase this rally. This is not your garden variety crash we saw over the past couple months, month and a half or so. We do think this is going to have longer reverberations through the economy. So let me show you guys a couple of charts before we look at the base case for the index. So first of all, sort of on a brighter note, this is what's projected right now in terms of a quarterly GDP hit for as a result of the coronavirus. So we're looking at something like on a quarter over quarter basis, we're talking about a minus 5% GDP hit. This is US numbers. But the good news is that we could then at some point see a fairly quick rebound of that, at least on an annualized basis. So what we're going to probably see is sort of kind of like a square root where you have now a very sharp contraction in GDP, then a good rebound to a good extent, but then it's going to probably flatline for an extended period of time. And I think that's really the point I'm trying to make, is a lot of people expect a V-shaped recovery. I don't think that's reasonable considering the amount of consumer, how much the economy relies on consumer spending and how many people lost their jobs. But at some point, obviously, this will be a major buying opportunity. We don't think we're quite there just yet. Now, the other thing I want to quickly point out to you, and this is also maybe a bit on the more hopeful sides of things, is this little chart. And I do a lot of searches on Google Trends, which I would encourage you to. And this one I didn't do myself. This one's from the Wall Street Journal. But you can see that the search term for coronavirus may have potentially, hopefully, peaked in March, mid-March, which kind of makes sense as, of course, the pandemic, went global and everything. So maybe, hopefully, again, I'm not a doctor, so I don't know, but maybe this is an early sign that we're going to start to see finally the flattening of the curves, not just in Europe, but also ultimately in the US. So that's just a bit of the encouraging news. And one more chart, and this is probably the most important thing here from a market perspective, for the more proactive investor out there. These are some statistics I came across in terms of what the maximum rallies were in bear markets. And you can see this goes back to the first statistic back in 73. And if you look at this row, you can see the maximum bounce was 24%. And this is more of a broad market basis. You can get, of course, much sharper bounces in individual pockets of the market, whether that's an ETF or certainly individual stocks. But if I take this into context now, and we look at how much the S&P has so far rallied, then I'm going to quickly go up here, and we're going to take the SPY ETF just as a comparison. And what you'll see is we have so far rallied from these lows down here up to here about, let's call it 21%. We're actually, as I'm recording this right now, the S&P is up another 2-3%. So we could just about call it 23, maybe 24%. So we are just about at the point where, by historical standards, we've had the maximum of bear market rally. Now, considering how sharp this move was, this was the fastest and move of its magnitude ever. Markets have increasingly gotten quicker over the years. I would not be surprised if we see something like a 50% retracement of the entire move, which on the SPY would get us to about 278 to 280. If you look at the S&P, I'm just going to quickly bring this up because some people like to look at the actual index as opposed to the ETF. Here we're looking at something like around 2,800. Of course, is how it translates. So that would be roughly where I would say things are going to get very, very, very difficult to go a lot higher. And on individual indices, if you look at subsegments of the market, different groups and sectors, that becomes even more apparent from a technical perspective. So, my very simple, warning here is that I don't think this should be chased. We have our own process where we divide markets into different time frames. And even though a lot of indices and even equities have gotten short-term bullish, they remain very clearly medium and longer term bearish, given or as a result of this severe sell-off. So we are actually just this morning sent out a trade alert to our clients that's going to hopefully take advantage of a retest of the lows in the indices. And so this, again, more than anything, just a warning, if you're getting excited about the rally we had over the past 10 days or particularly yesterday, even though there could be a little bit more upside, ultimately economic gravity is most likely going to make sure that we don't have a V-shaped recovery. These things are going to take time, and as a result, we're probably going to have equity markets go lower again before ultimately we have a more sustainable move to the upside. So anyway, folks, if you enjoy this, you have comments, questions, leave them down below. Subscribe. See you guys soon.